Good morning, everyone. Welcome to our webinar on cracking the due diligence code, insider tips for buying a business. My name's Anthony Satti. I'm a practice group leader here at LegalVision in the corporate and commercial team. Before we begin, a couple of quick housekeeping items. You'll receive this recording and the slides in an email. After the presentation. Please submit your questions in the chat box and we'll answer them at the end of the webinar. And please complete the feedback survey after the webinar ends. Also, all attendees are eligible to receive a free consultation with LegalVision to discuss how we can help you with your contracts or any of your other legal needs. To request a free consultation, just provide us with your contact details in the survey that appears at the end of the webinar. So today we'll be discussing a fair number of items relating to due diligence, a broad overview of what due diligence is about, what the due diligence process involves and search areas, a part around the term sheet, how due diligence links into a M&A sales agreement, and then we'll kind of dive into some very specific areas that you normally deal with in due diligence, going through financials, employees, corporate governance, material contracts, IP, and we'll end on a little interesting case, recent case on misleading and deceptive conduct involving due diligence. So what is due diligence? And you know, to put it into context, when we're talking about M&A transactions and where due diligence is relevant in M&A transactions, we're principally talking about either a business sale or an asset sale, where somebody sells all of the assets of their business, or alternatively a share sale transaction. So i.e. somebody buying and selling all of the share capital in a company, or majority part of that share capital. Now, due diligence, which is, I'll refer to that during this webinar sometimes as DD, is basically the process of auditing and verifying, investigating a potential target business and or potential target company, and really to confirm all of the facts and financial information and other information that the seller discloses to a buyer during that process. It'll involve usually inspecting and kind of meticulously going through business records and the physical assets, and potentially even meeting with staff. And really the whole purpose of DD from the buyer's perspective is to make sure that they are A, getting what they're paid for, B, that they're making an informed decision in undertaking this type of transaction. And also then kind of either discovering particular issues that either need to be dealt with in the sales contract, or potentially, issues that are so significant that you need to walk away from the deal. In the next slide, we've kind of broadly set out what the general process is involved in a sales transaction and where due diligence usually fits within that process. So it's normally the case, and not all transactions are run this way depending on the size of the transaction, but normally transactions are kind of follow this flow. Initially a buyer and a seller will meet. There might be an initial sharing of information, and the parties enter into a confidentiality agreement or an NDA. The parties might then move to a non-binding heads of agreement or a term sheet that sets out the basic commercial terms of the deal. And then from there, the buyer will start undertaking due diligence on the target company and the target buyer. Sorry, I beg your pardon, the target business. And in conjunction with that, usually simultaneously, there's negotiating of the sale agreement, and then from there, once the agreement's kind of been signed, finalized and negotiated, it's exchanged, and then the parties kind of move to completion. Now, who's involved in due diligence, and what are the best practices when undertaking this process? So it usually involves kind of the key stakeholders of shareholders, of the sellers, directors and senior managers of the sellers, directors and senior managers potentially of the buyer as well. Obviously, lawyers of both parties, accountants, corporate advisors, and potentially other specialist advisors, depending on the industry, which is the subject of the sales transaction. Now, best practice and is kind of, again, dependent upon the size of and complexity of the deal. But normally what we see during due diligence is that the buyer will prepare a full list of questions known as a request for information or a questionnaire about the particular target business or about about the sellers themselves. That will kind of also be supplemented by some sort of data room. Now, for bigger deals, parties will use third-party software providers like Answerada, which are pretty useful because they're really secure and are designed to facilitate a DD process. In smaller deals, we've seen parties simply go for something more simple and use things like Google Drive or Dropbox. And even smaller than that, sometimes parties, there is no data room. There's just simply a sharing of the various information and documents by email correspondence. But in any event, usually then what happens is that the seller will answer all of the questions set out in the questionnaire and the RFI and upload all of the relevant documents into the relevant data room. The buyer will digest all of that, and there might be then some follow-up questions involved, which again the sellers will basically respond to. In the next slide, we kind of set out what are the main search areas you as a buyer are kind of looking at when kind of auditing the target company and target business, and it obviously goes across quite a number of areas. So looking through corporate governance documents, looking through employee records, and inspecting potentially plant and equipment, going through material contracts, going through litigation and searches that are available on public sites such as the PPS, ASIC searches, bankruptcy searches, litigation searches, etc. Undertaking an assessment of any property leases or licenses that might be involved, looking at what insurances are in place for the business and potentially what insurance claims have transpired in the last number of years for that particular business, and obviously then looking at the financial accounts and records. So one of the kind of we went through this in terms of what is the general process involved in a sales transaction. One is the negotiation, usually of some sort of term sheet or heads of agreement. As I mentioned before, it'll set out what the parties agree broadly as the base commercial terms of the transaction. The term sheet itself will usually be non-binding. However, there will be certain clauses that are binding on the parties. Now, one of those clauses from the buyer's perspective that should be binding and that a buyer should be asking for in a term sheet is an exclusivity period. What are we talking about there? Basically, that there is a period of time that the seller can't go off and shop that company or business to any third party. And usually what we see in the market is around 3 to 6 months being an exclusivity period. Why is that important? For a buyer, first of all, obviously you want first dibs. You're going to be devoting significant resources and time and money in undertaking that DD. So I guess you want that level of security that nobody else is going to be involved, or no other third-party potential buyers are going to be involved, and it also gives really a good amount of time for the due diligence process to successfully be undertaken. It's also not unusual, depending on the nature of the deal, for a buyer to be asking for an indemnity in the term sheet for a breach of those exclusivity periods or exclusivity rights. Again, which is kind of linked to the fact that you will be expending time and money in engaging advisors and other people to undertake DD. So what's the link? Why is DD important also, from the perspective of the sales agreement? Now, kind of first principles is that in the sales agreement, it will contain a set of warranties that the seller gives to the buyer about the target business or the target company, and about the sellers themselves. So, for example, that the seller owns all the shares in the target company without any encumbrances, or potentially that that the target company has not been involved in any litigation for the last 3 years, or potentially well, not potentially, usually what we see is, or like, for example, a warranty that the business assets are in good working, plant and equipment are in good working order, and that the seller has complied with all privacy and WHS laws, for example. So if a seller breaches those warranties, in the sense that they subsequently become untrue, then the buyer will have a claim against the seller for damages that it suffers as a result of that warranty. And usually the sale agreement will also include an indemnity for breaches of warranty, which basically means that the buyer, you as a buyer, gets to sue the seller for damages arising from that breach of warranty as a contractual debt. Now, the way that a seller makes sure that they limit their liability and exposure for breach of warranty claims is to disclose against those warranties. And so what do we mean there? Basically, there'll be a provision in the sale agreement that says something to the effect of the seller won't be liable for any breach of warranty claim to the extent that it's provided information and made representations within the various due diligence or disclosure materials. And usually what we're talking about there is all the information that's been kind of uploaded by them in the data room. So from the buyer's perspective, it's then therefore really important during the DD process to be obviously undertaking a very thorough DD over the target business or target company, because it'll either find things that are so material that potentially you need to walk away from the deal because you don't want to take on that risk, or alternatively, it could be that you ask for specific indemnities in the agreement from the seller. So what I'm saying there is basically a specific a clause specifically in the agreement which says something to the effect of that the seller agrees to pay you for any loss that you suffer as a buyer as a result of that particular issue. So as an example, maybe during DD you've discovered that there's a nasty piece of litigation that the company is embroiled in with a former employee, and potentially that claim is quite sizable in nature. So it'll potentially be really important for you to get a specific indemnity from the shareholders and directors over that particular claim, to the extent that you have to incur any loss or suffer any loss as a result of that litigation. It's also really useful, the DD process, to kind of highlight issues that potentially just need to be dealt with at the time of completion, and they're expressed as being conditioned precedents to completion, or potentially they're just simply completion obligations. The difference being that a condition precedent is something that if the event doesn't happen, you as a buyer just get to walk away from the deal, versus a completion obligation, which is an absolute obligation on the seller that they must do this at completion in order for completion to happen. And if they don't, then you get to sue them potentially for a breach of contract claim. So as an example, something that you might find during due diligence that might be a condition precedent is you've realised that there's a key employee that is basically responsible for the majority of the sales of the company, and so it's a CP that key employee is engaged by you and signs an employment agreement with you to continue on that. For example, it could be something along the lines of you've discovered the target company has a whole bunch of shareholder loans out there, and you make it a CP or completion obligation that those shareholder loans need to be repaid before you assume control of the company. So let's get into some of the very specific areas that you focus on during DD. The biggest one is the financials, reports, and tax. And for a lot of buyers who might be new to this area, you're very much relying on sitting down with your accountant and your tax advisor, or potentially your internal financial advisors, if you're big enough, to be really going through the books and really just making sure that all the numbers stack up. Making understanding, is the company profitable? Has it been actually performing the way that it's been? They say that it's been performing. Is there any veracity in forecasts that might have been given to us? And basically, is the purchase price that I'm about to pay for this legitimate, particularly in circumstances where maybe the purchase price that you're paying is based on a multiple of EBITDA, which is earnings before interest, tax, and amortization. Basically, most of the time it's looking through balance sheets, looking at profit and loss statements, management accounts for a certain period of time beforehand, usually the 3 years, the prior 3 years, going through tax returns, annual returns, etc., and lodgements. Another key kind of area is looking through what the situation is with your employees and or with the target businesses or target contractors, target companies, employees or contractors. And as a buyer, what are you usually asking for? You're usually asking for a full list of all of the employees and all of their employment entitlements, their salaries, bonuses, any employee share schemes that they might be involved in, etc. You want to be looking at what contracts, employment contracts that they've got in place, and what are the rights and obligations of both parties under those contracts. Are there any side agreements potentially that have been entered into with employees? Has there been historical or disputes, or are there any current disputes with employees, which is pretty important from the perspective of also understanding what the culture is like at a particular in a particular business, and that's very much a practical issue, I think, in undertaking DD, particularly where you're looking to merge that business into your own business. Is, are they the right cultural fit with your organisation? There's an assessment of how the company or how the business is done in terms of compliance with relevant awards and other employment related legislation. So by way of example, we've seen in recent years people like George Columbaris being stung by not paying staff award rates, and then having to go back and pay some pretty big amounts because people were being underpaid. Looking at contractor arrangements, are those contractors legitimate contractors? Has there potentially been a situation where there's been sham contracting arrangements in place, and really those people are deemed employees and should have been deemed employees? And then what are the consequences and risks involved with that? I think one of the big parts in any M&A deal, particularly for business sales, is where usually there's purchase price adjustments relating to the employment entitlements that that the buyer needs to assume. Taking on personal leave and annual leave for a bigger organisation with hundreds of employees can be a pretty big liability, and so then that kind of retrofits into negotiations on purchase price and what amount of an adjustment is made in either party's favour in respect of those particular entitlements that you're assuming. Another key area, and I think this is probably more relevant in the context of a share sale or share acquisition transaction, more so than an asset sale transaction, is going through basically the company books and the corporate governance. So really reviewing, the company's corporate register, members register, resolutions, both at the board and member level. Do they all stack up? Have they been validly passed? is the ASIC record up to date? What's their shareholders agreement look like? Are there any relevant provisions in there that we need to potentially deal with in terms of approvals of the transaction or otherwise? If you're in a share sale transaction and it involves a major shareholder having to drag minor shareholders along, what are those drag along rights say in the shareholders agreement? Doing a bit of a sanity or a health check on the constitution of the company. Again, are there any relevant provisions there? And then also assessing what other securities that a company might have. You as a buyer trying to buy 100% of the capital of a company will be really worried about other forms of securities that might be out there, like convertible notes or safes, simple agreements for future equity, or any other forms of securities that might be converted into shares. And obviously you will want those securities to be converted into shares before completion so that you're acquiring 100% of the company. And I think I lump into corporate governance also kind of looking at what are the licenses and regulatory approvals that particular business has, and what is the state of those approvals. So, an example of this is you potentially looking to buy a business that is an insurance broking firm, for example, and holds an Australian financial service license. So looking through those licenses, looking at what conditions are on the licenses, looking at how the company has complied with all the relevant financial services laws. Material contracts. So as a buyer, you'll definitely want to be kind of seeing all the agreements that a target company or a business has that are significant to its ongoing operation, to its future profitability, really, and that is drilling down into customer agreements, particularly those that are key customers, supply agreements. So for example, you might be acquiring a business that is a distributor of wines. So it's going to be really critical for you to be making sure that you're doing a thorough assessment of the state of those distribution agreements that business might have with overseas brands and overseas parties. Looking through real property leases and licenses for business premises, looking through equipment leases. There might be a number of items of equipment that either the business hires itself in order to operate, or that it leases to other people as part of its income. And I think then kind of you're also looking at potentially other IP licenses with third parties, and just generally other supplier contracts. What are the kind of key issues that a buyer is looking for when they're assessing these agreements? I think you're pretty much looking at whether there are change of control provisions, which is relevant for a share sale transaction, because then you'll need to get third-party consents for changes of underlying control. If it's an asset sale, you're looking at what are the obligations and provisions relating to assignment and novation. And then generally, I think you're doing a bit of a sanity check on that agreement to see, are there any onerous terms? What are the termination rights of the other parties? Have there been any historical claims in respect of these contracts as between the parties? Those type of things. And again, it links to the sale agreement, because potentially these are things that are either becoming condition precedents or completion obligations. So, for example, you might find that you're buying a professional services business, where the biggest client that the business has is one of the government departments, and so it's going to be really crucial for your acquisition that government contract is assigned over to you, for example. Another key area is looking at the state of intellectual property in a business, and going through things like and assessing whether any of that intellectual property has been registered. So, for example, trademarks or patents or designs. If they haven't been registered, potentially should they be registered? Should that be something that you are requiring as a condition precedent or a completion obligation by the vendor? has the main IP of the business been generated by third parties? We see a lot of businesses that are in the apps and software as a service space have those platforms been developed by third-party developers, and then you need to make sure that those contracts that they've potentially entered into with those third parties have got the right provisions in there to make sure that the business owns that IP. And if it doesn't, then again, potentially requiring IP assignment agreements from those contractors before you complete, so that you own that valuable asset. I think you're also kind of undertaking searches of what else is out there in the marketplace. Are there third parties that potentially are infringing the business's rights? Are there brands out there that sound similar or are competing against you that maybe there should be some action taken against them? Has there been any past litigation relating to third-party infringement, third-party IP infringement claims by the business itself? Like potentially has the business's marks infringe somebody else's IP, or risks that you need to assess. And then kind of the last area that I wanted to touch on, which is a bit of a kind of a different thing to be thinking of when you're thinking about due diligence both from a buyer and a seller's perspective. But I guess I wanted to talk a little bit about misleading and deceptive conduct, because the concept doesn't actually only arise in the concept in the context of consumer law. So many of us are probably used to hearing about that in the consumer simply in the consumer law space, but it actually also extends to potentially to business sale transactions. It's really important for vendors that that potentially that they're not engaging that this type of conduct, and the kind of the key takeaway is that notwithstanding that they might try and impose certain carve-outs or limitations in the sale agreement, that's not going to help them. They still might be the subject of a misleading and deceptive conduct claim. And this actually came up in a case that happened at the end of last year. QVP Pharmacy versus Lee in New South Wales. That case involved the sale of a pharmacy located in the QVP here in Sydney. Basically in that particular, the facts of that case was that the purchaser had basically handed over to the seller a whole bunch of accounts and records relating to the pharmacy, including reports detailing pharmaceutical benefit scheme payments and private script sales. And on the basis of that information, the buyer went off and got a valuation of the business, and then which was, I think, estimated that the goodwill was of some $750,000, and on the basis of that valuation, that formed the basis of the purchase price that he ultimately paid. The purchaser then took control of the business, they completed, and it subsequently came to light that in essence, a lot of the information that the seller had given to them was completely false, and that the buyer basically had overpaid by a significant amount of money. And so he basically commenced action against the seller, and one of the claims he made against them was engaging in misleading and deceptive conduct. Now, the seller tried to raise a number of arguments to defend themselves. One of the interesting ones was that there were various clauses in the sale agreement where the purchaser acknowledged that they were purchasing the business as a result of their own inspections and investigations, and to the extent that there wasn't any to the extent that it basically excluded out any other warranties or representations other than what was expressly included in the agreement, and there weren't any warranties or representations about the state of the accounts or the financial reports and whether they were materially accurate, etc. Basically, the court in that particular case went through a number of things, but on that particular limb said, no, absolutely not. Mr. Seller, you can't rely on that clause in the contract. It's really clear that you gave false information, and the buyer relied on that information in engaging in the transaction, and probably wouldn't have entered into the transaction if you hadn't have undertaken that misleading and deceptive conduct. And ultimately, the court in that case found in favour of the buyer and awarded them $1 million in damages. So, from the buyer's perspective, obviously from the vendor's perspective, really important that you're not engaging in that type of conduct and you're being really transparent and honest in a transaction. But from the buyer's perspective, also important to be thinking about making sure you're getting a comprehensive set of warranties in your sale agreement, and one of which is always making sure that you're including a warranty around that the information that's been disclosed in the due diligence materials or in the data room is materially accurate and correct. Basically, that concludes the main part of our webinar. You might find our publication Due Diligence Guide for Purchasing a Business very useful to you, and you can download that in the handout panel or just by scanning the QR code. We also have an upcoming event that might be of interest to you on Buying a Business 101, Sales Contract Essentials, and that'll take place on Thursday, the 14th of September at 11 a.m. Australian Eastern Standard Time, and you can register on the link shown on the screen. Now we're going to answer some of your questions shortly, and I can see that some people have actually sent through a couple of questions on the Q&A. While you submit them, or any further questions you might have, we'll take a minute to tell you a little bit about the LegalVision membership. LegalVision membership is a really cost-effective alternative to have all your business as usual legal needs covered. For a fixed monthly fee, you not only receive cost certainty, but all the inclusive benefits such as unlimited document review, which would include reviewing your commercial contracts, unlimited consultations, which means that you basically get to book a meeting with an LV lawyer at any time to discuss your business as usual legal needs. And you can talk to any of our lawyers, including about franchising, corporate employment, depending on your particular needs. And your membership offers unlimited trademark registration, all for a very reasonable and competitive monthly fee, with options to purchase extra credit towards more complex matters like ongoing disputes or certain M&A transactions, which we charge on a hourly rates basis. Now we'll answer some of your questions that have kind of come through. One of the ones that came through before the presentation or the webinar was what aspects should we consider when buying a business in the food grocery industry? I think, obviously we've kind of covered a lot of that within our presentation and webinar. I think if you were looking at potentially buying a grocery business itself, if that's what was intended, then certainly I think you would be having a really close inspection of probably the underlying lease of that premises and all the supplier arrangements naturally that you would have. And then I dare say there would be quite a lot of regulatory compliance reviews that would need to be had of that particular business. Another question that's come through is, can you advise on benefits of engaging a lawyer when buying a business? Look, I think it goes without saying that a lawyer is going to be able to help you through much of the due diligence, at least from the legal perspective. But most importantly, they're going to be able to help you negotiate the terms of, not only your heads of agreement or your term sheet, but more importantly, the sales agreement itself. They should know what is market standard, what is reasonable, and if they're whether they're acting for you as a buyer or a seller, they're going to be able to make sure that there's provisions in those documents that best protect you and inoculate you from risk. Another question was, do you have any advice for individuals selling a business, seeking to sell a business, and does that differ from advice when buying a business? I could probably have a whole presentation on that question, I think alone, but I think really high level, yes, the approach that I think the approach that you take as a lawyer when helping clients, whether they're a seller or a buyer, definitely changes, particularly when it comes to the sale agreement and the type of clauses that you're seeking to include to best protect them. But I think for a person that's looking to sell their business, I would say very high level, make sure that you're ready for DD, getting all your documents and your business ready for a prospective buyer. Have a good, clear vision of what you're looking for in terms of a purchase price and an exit. And make sure that you're engaging with the right advisors to help you sell your business. Get your accountant involved, get the right lawyers involved, potentially get a corporate advisor involved, because they're going to help you get the best deal possible for you. There's some other questions that have come through. How would you carve out the exclusivity and indemnity as binding on a non-binding HOA? Usually it's actually really simple. There's just a very specific clause within the term sheet that delineates pretty much, that says, all of the terms in this heads of agreement are non-binding except for XYZ clauses which the parties agree are binding upon them. So that's a really easy fix that we see in all term sheets. Another question that's come through, how do you advise a prospective purchaser to value a business, and at what point should they obtain a valuation, before or after DD? Look, I think it's probably within the realm of either your accountants undertaking their own valuation, and during DD, while given that they would be privy to all the relevant financial and other information and reports, and then doing a valuation based on that information, and they'll be able to hopefully use right valuation methodologies. Valuation, you can also engage people that are specifically valuation experts. As I understand it, that can sometimes be a bit of a costly exercise, but I guess depending on the nature of the deal and the size of the deal, you might think that there is, some real value in engaging that a certified valuer to undertake that task. Another question: to what extent does a seller have to disclose knowledge of changes that will affect the business in the near future? Look, I mean, I think that'll come down to probably two areas. One is potentially adding some very specific questions about maybe things that you're concerned about within your industry that might affect the future within the questionnaire and the due diligence process. But also you could potentially include certain obligations, certain obligations and or warranties within the sales agreement itself. So usually there's a time period between signing and completion, and you might be wanting to include a clause in there that deals with material adverse changes, i.e. that there's an obligation on them to at least disclose to the buyer if there's been any material adverse change in the business during that time period. And then you might also be including some warranties, in the document as well, that the sellers disclosed everything, as far as they're aware, everything that might be material to a buyer that might affect the business for a specific issue, affecting the business after for a reasonable period after completion, for example. And then I think the final question that's come through is, how do you verify that sales reports provided by business owners are accurate and correct? Probably not something I myself have had to undertake as a task as a lawyer, but I certainly think that it's probably more in the realm of your accountants or other advisor to be who are familiar with those reports, to be kind of going through that and potentially reconciling those particular reports with other data from that's been made available to you in the data room about the business. such as looking through invoices and reconciling that against, for example, stock amounts, etc. So I think that's all in terms of questions. That's all we have. We don't have any other questions at the moment, and I think we'll kind of call the webinar at an end. That's all we have time for today. After the webinar ends, and please note that a survey will pop up. We would really, really appreciate if you could complete that 30-second survey, and by all means, please do include your contact details as you'll receive a complimentary legal consultation to discuss how LegalVision might be able to help you. Thanks everyone very much for your time this morning, and I hope you all enjoy the rest of your day.